Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We bring you all the top news in business and economics and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries all around the world. They also cover commodities. And for that, we go to Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist. Mike, the news that Bloomberg broke yesterday is that U.S. tariffs on copper imports would be coming within several weeks before a conclusion that was going to take like 270 days. Can we just do like a primer here? When we say copper imports, are we talking like the stuff that comes out of the ground? Are we talking like refined things? Are we talking like copper wires? Do we have an idea yet of what that looks like?
Well, for me, it's the refined copper, Alix. The U.S. imports about 50%. It's one of the few commodities that we have a deficit of. Obviously, it's spiking up. But what you mentioned is still, it hasn't happened yet. Market's anticipating up to 25% tariffs. And the price, the CME U.S. traded copper has jumped to about 20% premium versus the LME traded copper. So it's already priced in, and we still haven't had it. And I think we're at the point where the market, the Trump administration is going to realize, okay, yeah, we need to kind of reduce inflation, increase American productivity, American onshoring production to U.S. And if we spike the price of copper too much, that's not going to help our goals. So I'm kind of worried now that copper is at that huge premium. It's the highest price ever. And so I'll give you an example, right? U.S. copper right now is right now about $5.30 a pound. It's the highest ever. The equivalent in London is about $4.50.
So
Wow.
Can we just explain that for a second?
Yes, please.
Okay.
It's been a light bulb for me today.
Because I did explain this to Paul in commercial
Yes,
break. But in fairness, he asked. So the COMEX price, which is the U.S. listed price, is by pound. And that's versus tons, which is in the London exchange. And there's 2,000 pounds per ton. So that's how you get the price discrepancy and kind of where we're at. You're welcome.
Mike, do you arbitrage that? Do you commodities people arbitrage that stuff?
Oh, yeah.
Oh, well, they're doing it now. Yeah, Alix is all from a trader standpoint. That's what I look at. It's arbitrage. So I just take that London price, convert it to pounds, and you can see over time it's been the same spread forever. Since we have data since 1997 for that, and now it's 20% higher in the U.S. That's just never happened. So I think what that is, it's indicative of how profound these tariffs are. I mean, this is a shift in the global world order. Post-World War II, where the rest of the world was able to depend on exporting stuff to the U.S. That's changing. Now, copper is one of the things we do import. But look at things like crude oil. We have a surplus of crude oil. Crude oil's down. We have a surplus of grains, corn, soybeans, wheat. They're having pressure. Copper's at the forefront right now. I just look at it in the short term. This is a trader's trade. I look at it as a trader like, yeah, I might be structuring put strategies. I've been wrong so far, admitted. But you know what? In one tweet, it can drop 20% and just go right back to parity with what's trading in the rest of the world.
And is that how you think about valuation in this market, the copper market? Is it Chicago versus London, or is there another way to get a sense of valuation? Are we stretched?
Well, I love using that word in this case, Paul. What usually happens, if you can identify spikes in commodities and be on board, people are doing that in copper, you're doing fine. The point is, almost every time you get an aberration when a commodity spikes like this, it always go down. What's the most recent example? Eggs. I mean, they spike up for a little while, we find supply, cut off demand, and they go down. So it's just a question how far it goes. What's unique in this case is last year we could really see in futures driving that price higher. Managed money, hedge funds, futures positions were driving it higher. They got up to about 32% of total copper and open interest. Now they're 9 to 10%. They don't really care because I think they know what's happening. We're squeezing a few shorts. You just can't see how obnoxious it is. And at some point, I just don't know how it can stay up here, particularly if the U.S. stock market continues to trickle down, which is the base case from people like Gina Martin Adams.
So using these ARBs to trade, is nothing new. And we see a lot of these dislocations a lot, too, especially if you factor in Shanghai copper as well and how you then store it and then playing it. Typically, when these distortions happen, how do they wind up resolving?
Well, usually it's some kind of futures. You have to move copper towards the U.S. How you get there into inventory is kind of complicated. Usually it's just a matter of how wide it goes before it goes back to disparity, back to parity. And the question is how it does that. And that's key things I'm looking forward to. What can make that happen? First of all, time. It's not going to last too long. It just markets will move to where prices will benefit. And then the key thing is you have to worry about, if you're long U.S. copper, you have to worry about just the next social media tweet from a Trump administration official might say, yeah, we were going to do 25% tariffs. Maybe we're going to do 10 to 15% because the copper price is telling us we might be a bit extreme here. So there's a lot of nuances, but the thing is, the risk is you can turn around in one day and what's been up 30% this year can drop 30% or 20% in a heartbeat.
All right, so we've talked about tariffs and copper. Are there other commodities that you're paying attention to, Mike, as it relates to tariffs?
That's the main one. Steel is in there, but steel's kind of a bit out of my purview because it doesn't trade a lot in actively traded futures, but copper's the number one right now. But I like to point out the key thing that's really happening is because we're having this trade war, war you could call it, it's the surplus commodities in the U.S. that are major under pressure, and that means crude oil, liquid fuels, natural gas, potentially at a peak around 4, and the grains. If we do have truce in Ukraine, Russia, grains are already in a bear market, it'll pressure them lower. They would have to depend on the U.S. drought to go up, in my view.
And gold, what do you think? Still going to rocket higher here?
No, see, still bullish. The way I see gold, it's reached a good threshold of $3,000 an ounce. It's pretty much overbought. It basically needs bull fuel, and that bull fuel, the top source of that would be the U.S. stock market going down, which we know is basically deflationary. Good for gold, but probably maybe tilt over and help U.S. long bonds.
All right, Mike, really appreciate you. Thank you so much. Mike McGlone, Bloomberg Intelligence Senior Commodity Strategist.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Sally Bakewell joins us. She's Bloomberg U.S. Finance team leader on a story I like to read. And just by definition, it's going to be one of the most read stories on the Bloomberg terminal today. Wall Street bonus pool surges to a record $47.5 billion for 2024. Woohoo! So, Sally, I mean, a good year on Wall Street. It seems like people are getting paid, aren't they?
People are getting paid. I think it was largely driven by a great 2024. We started to see deals bouncing back, but I think a big part of this was also the volatility in trading created by the election. I mean, we reported in December that executives atop the biggest banks were locking in plans to award traders and deal makers the biggest bonuses since the pandemic, with some hikes as much as 10% or more.
How much of this is actual results versus just the competition for talent with a little bit of results sprinkled in?
I think this is probably really more reflective of the results.
Oh, okay.
But obviously lifting bonuses faster can help ensure that employees stay around for more business to come. And initially, the beginning of this year and toward the end of last year, we expected a big deal rebound. So that seemed much more important than it does perhaps now, that things are a little more uncertain on Trump's tariff policies, which are kind of clouding that rebound, which in turn sort of makes the talent less of an in-demand thing potentially.
One of the more interesting parts of this story is that Wall Street employment has hit record levels. Now, I kind of thought this whole AI thing and automation and would have maybe caused headcount to maybe come down, but there's still a lot of people working on global Wall Street.
That is correct. I think the trend has generally been for employment to go up at Wall Street firms despite this. I think because so many of them are trying to modernize and improve their technology, that has caused them to need to hire more people. And perhaps, and a lot of them also give this message that even with the advent of AI and using AI, actually, we still need humans in order to
humans.
Verify it.
Yes.
I mean, hey, as media people, let's take it. Let's take the win when we can get it. I guess the question is, does this kind of payout last? Because as you mentioned rightly, that M&A boom that we've been waiting for hasn't happened. The IPO market being wide open has barely happened. We have a couple that are squeaking through. And until the uncertainty settles down, it's hard to see that actually panning out.
Yeah, I mean, a lot of the bank executives are now outwardly saying that certain things are on pause, certain things are frozen, because big sort of deals, big companies with deals, they absolutely don't want to come out and hit the market in a sort of uncertain environment. We have seen a few, but the general message that Wall Street is very open about is that things are on a bit of a holding pattern at the moment.
Hey, Sally, can I ask a quick question?
See, he likes the ones about money. He's into it now.
Well, no, from the peanut gallery over here. How much of the local economy, and I'm talking New York State, New York City, Connecticut, New Jersey, depend on Wall Street for tax revenue and et cetera, so forth?
Well, Wall Street is responsible for 17.7% of all economic activity in the city.
Really?
Really.
See, we're important.
Okay. And Wall Street also accounted for about 19% of New York State's tax revenue between 2023 and 2024. And the estimates we got today are that for 2024 bonuses, they'll generate about $600 million more in state income tax. And obviously this is very important, particularly as New York City is sort of struggling somewhat with potential budget gaps created by cuts to federal funding. And New York City, relies heavily on federal funding for various programs like Medicaid and the Essential Plan. So it does have an importance here.
Here's another great data point in the story. New York City's share of securities industry jobs nationally has declined to 18% from about 33% in 1990 as financial firms move jobs to other regions to drive down costs.
Florida?
Yeah. And like Goldman Sachs has got a big place in Salt Lake.
Really?
Salt Lake. I mean, they're all over. They're just lower cost.
So you don't have to be here necessarily?
No.
You can go to a place with good weather?
Exactly right. Deutsche Bank has a big place down in Jacksonville, for example. So you don't have to send these jobs off to India. You can just put them to the Midwest or the South or somewhere else.
Right, expand that.
Yeah, so interesting.
Sally, thanks a lot. We really appreciate it. It's a must-read, guys. It's always really fun to dissect those stories. Sally Bakewell joining us on that, Bloomberg U.S. finance team leader.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Andrew Silvernail joins us here. He's the CEO of International Paper. IP is the ticker. Put it into your Bloomberg terminal. He joins us here in our Bloomberg Interactive studios. The fact that you're in our studio makes me believe that you had an investor day recently.
We
yesterday.
did. Yeah, we had an investor day yesterday. Great
What
day.
was the theme of the investor day today that you had yesterday?
Yeah, transformation.
Okay.
It's really about the transformation. I heard it in the opening talking about International Paper. Of course, it's in our name, and so people think global paper. And the reality is we're a packaging company now. So almost 100% sustainable packaging with the acquisition of DS Smith. North America and Europe, we're number one in both places, and we're focused on the customer and their packaging needs. You mentioned Chewy before.
Yeah.
Great customer for us, and a wonderful opportunity to build their branding to help them be successful. That's what we're all about, is transforming into a packaging company.
So something that definitely came up is value over volume. You want to get the most out of what you're doing rather than just the numbers. UPS is doing something very similar, and in the short term, there's a lot of angst and pain kind of around that before you get to that volume, up to that value growth. Talk me through the cycle.
Yeah, so if you think about, we were our own worst enemy. So for years and years and years, we would chase volume at the most inopportune time. Mm-hmm. And so what we effectively had to do is go back to the marketplace and say, we need to be paid for the value that we're bringing. And that's what we do. We come into the marketplace, we're trying to help you get your goods to the place you want them to be, whether it's fast-moving consumer goods or it's industrial goods. That's what we're trying to help. But we've got to make sure that we're taking care of all of our constituents. And frankly, we weren't. And so we've got to get that value proposition right. I think we've made that switch over the last couple of years. We're seeing that start to play out appropriately, and we're getting paid for the value that we bring.
You're building a state-of-the-art box plant in Waterloo, Iowa. So talk about onshoring. That's big time, $260 million. Talk to us about that investment. What are you trying to do there?
So what a lot of people don't understand about the packaging business, certainly the paper-based packaging business, is all of the business is done within 200 miles, a 200-mile radius of a plant. And because you can't, air is expensive to ship, and so you've got to be close. So we want to be close to our best customers. That's Protein Alley. So that area, there's Protein Alley.
Protein Alley.
Protein Alley.
Really? I hadn't heard that before.
Fantastic. Yeah, think of the beef and the chickens.
Yeah, I had not heard that before.
And so if you think about kind of where protein happens in the United States, from if you think of the South all the way through the Midwest, through there, we want to be close to our customers. We have a great customer relationships. We need a modern facility. We're going to have I think it's going to be the largest facility in the U.S. that does paper-based packaging. And we want to make sure, because we're shipping in from other parts of the country now to service those customers. It's very ineffective, very inefficient. We want to be local, we want to be close, we want to drive customer service and innovation as close to the customer as we can.
international is in your name.
Yeah.
So how are you affected by potential tariffs and every country's shift to nationalism, whatever that way that is? Energy nationalism, goods nationalism, supply chain nationalism. Where do you play, and that has affect you?
Yeah, so we're definitely an international company, principally North America and Europe. We're about 2/3 North America and a third Europe. We don't ship actually a lot across borders, believe it or not. So that doesn't happen. So we're not being impacted directly by tariffs with cross-border trade, but we're impacted by the economy. And so as tariffs impact the economy, that will have an impact of us. So we're watching what's going on, and we see it in our numbers. We've seen the volatility in the last month or so. So we're keeping a close eye on that, but that's really how it impacts us.
What are your customers saying about their outlook for the economy? I would think that you would have a finger on the pulse of that.
I think we do have a pretty good pulse. I think there's uncertainty, if we're fair about that. The last month or two or so, there's been some real uncertainty, and I think while nothing's really happened yet, it's caused people to retrench a little bit and ask, hey, do I want to make that investment right now? Can I hold off on spending money right now? And let's see. Look, my belief is these things wash out over time, and we make investments for decades. We don't make investments for quarters or even years. And so we're thinking about investments for the long term.
In terms of, say, hiring labor, how you're managing the business, is it a retrenchment time? Is it expansion? How would you define it for you guys?
Actually, interestingly, it's a little bit of both, right? And what I mean by that
Can you
is,
have both?
Yeah, you can,
Okay.
actually. So when you think about that, you have certain parts of your business that aren't as strong or aren't as healthy, and you have other parts that are very healthy. So as an example, Protein Alley, very healthy for us. Let's make investments in Waterloo, Iowa. Let's move let's move people, and let's move investment there. Things that are weaker, things that are struggling, or markets you're not as strong in, you have to retrench. So you have to do both.
What areas are those?
Well, you've got softness in parts of the economy, kind of broad base. You've got to be concerned about things that are going to shrink over time, and things like e-commerce that are strong, things like protein and fresh vegetables, those are strong. You want to move towards those things, and so we want to move our investment towards the parts of the economy that we think are going to expand over time, location and industry, and really grow on those strengths.
So to the extent, if I think about your company, I think about a GDP top line growth story. Is there anything different than that? I mean, that's it. And is your business really about managing the costs and managing to margin?
No, it's not.
Okay.
I mean, yes, you always have to manage your cost, right? But the key thing is you want to align yourself with where growth is.
Okay.
I think that's the biggest thing. Bottom line, though, is we're going to generally follow the economy. So yesterday in our investor day, we talked about a volume growth that's kind of 1% to 2% that follows underlying volume growth, and pricing power over time that's also about 1% to 2%. So we think we're a 3% to 4% grower over time, the core market. And then that question is, can you align with better growing industries and can you win market share?
Andrew, thank you so much for joining us. Really appreciate you taking a few minutes of your time here today. Andrew Silvernair, he's the CEO of International Paper. No surprise, the ticker symbol is IP. Log it into your Bloomberg terminal. He joins us here in our Bloomberg Interactive Broker studio. They had their investor day yesterday. The stock's up 45% over the trailing 12 months, so it's had some pretty solid performance.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.